Welcome to The Explainer. Today, we're diving into a term you'll see on pretty much every income statement out there: cost of goods sold. Now, it might just sound like simple math, but as you're about to see, the story this one number tells about a company's real health and strategy, well, it's anything but simple. So let's get right into it. Imagine a business sells a cool t-shirt for, say, 20 bucks. Is that $20 of pure profit in their pocket? No way, not even close. Before you can even begin to count your profit, you've got to subtract the cost of the actual shirt, the ink for the design, and even the labor to print it. Those costs, those are the key to figuring out a business's true profitability. And that's exactly what we're going to unpack today. All right, here's our game plan. First, we'll nail down a really clear definition of cost of goods sold, or COGS for short. Then, we're going to explore why this single number is so incredibly important. After that, we'll look at the 3 different ways companies can calculate it. And finally, we'll get into how they deal with the messy reality when things don't quite add up. Okay, let's start at the beginning. Picture a small business that sells beautiful handmade wooden chairs. Think about everything that goes into making one chair. You've got the wood, the screws, the paint, and of course, the wages for the carpenter who built it. All those costs that are physically a part of that chair, that is the heart of what we're talking about here. The most important word on this slide is direct. CGS is all about the direct costs of producing the stuff you sold. And that's a really crucial distinction because it means we leave out all the indirect costs. So the rent on the workshop? Nope. The money you spend on marketing? Not part of CGS. Your office administrator's salary? That's out too. We are only, and I mean only, talking about the expenses that are basically baked right into the product itself. So, now we know what CGS is, but why does this one line on a financial statement get so much attention from analysts, investors, you name it? Well, it's because it's the very first clue to understanding how efficiently a company can turn its raw materials into actual spendable profit. And here you can really see its power. CGS is subtracted from revenue right at the top of the income statement to figure out something called gross profit. So a higher CGS means a lower gross profit. It's that simple. This one number directly shapes a company's reported income and sends this huge signal to investors about how good that company is at making and selling its products. All right, now this is where things get really, really interesting. You think a cost is just a cost, right? It happened, you paid it, that's it. But it turns out the accounting method a company picks can totally change its final CGS number. Let's look at the 3 main ways they do it. This table breaks it down perfectly. First up, you've got FIFO. That stands for first in, first out. Just think of a grocery store pushing the oldest cartons of milk to the front. They want to sell those first, right? The opposite is LIFO, last in, first out, which assumes you're selling your newest stuff first. And then there's the third method, weighted average, which kind of smooths everything out by just using the average cost of all the inventory you have on hand. So why does any of this matter? Well, let's say prices are going up. Inflation. Suddenly, these 2 methods give you very different results. If you use FIFO, you're technically selling your older, cheaper inventory first. That means your CGS is lower and your profit looks higher on paper. But with LIFO, you're selling the newer, more expensive stuff first, which makes your CGS higher and your reported profit lower. Same company, same sales, but a totally different bottom line, all because of an accounting choice. Of course, accounting often lives in the clean, perfect world of spreadsheets. But business, that happens in the messy, real world. So what happens when what you have in your records doesn't match what's actually sitting in the warehouse? This is a problem that every single business dealing with physical products has to face. It's called inventory shrinkage. Maybe some products got damaged in a shipment, or they expired, or they just got misplaced in the warehouse. Sometimes things are even stolen. The point is, your accounting records might say you have 1,000 items, but you have to square that with what you can actually find and sell. So how do companies fix this? Well, the process is pretty logical. First, they have to do a full physical count of everything they have. Step 2 is to compare that real-world number to what's in their books. And finally, whatever the difference is gets logged as an adjustment, which almost always means increasing the cost of goods sold to account for that lost inventory. And this right here is the critical takeaway. For a company's financial reports to mean anything at all, they have to match reality. This whole process of matching what's on the warehouse shelves with what's in the spreadsheets is an absolute pillar of good accounting. Without it, your profit numbers are really just a shot in the dark. So that brings us to our last big question. We've seen that the choice between FIFO and LIFO can literally change a company's reported profit and even its tax bill. So, is this just a boring technical accounting decision, or is it a strategic financial move used on purpose to shape how investors and the market see a company? That's something to think about the next time you look at an income statement. Thanks for watching, and we'll see you on the next Explain.